Chapter 4, Completing the Accounting Cycle. We're going to talk a little bit about what a worksheet is. A worksheet is not one of the required reports or really required at all for doing the financial statements. But using a manual or electronic worksheet, which usually ends up being an Excel spreadsheet, can offer a lot of benefits, and actually in practice you see that virtually all accounting people, whether it be internal accounting people, auditors, etc., use worksheets. And in this case, when we talk about worksheet, we're basically just using that as kind of a little bit more formal, almost scratch paper type of deal. So some of the potential benefits are listed here. And as we walk through this example, you'll see kind of how this can be beneficial. So here we have a 10-column worksheet that, or this is the beginning of a 10-column worksheet that contains the year-end unadjusted trial balance for a company called Magic Company as of December 31st, 20x2. And obviously that X there, it basically just tries to make this timeless, at least for the next 100 years. So insert whatever into that X to make it the most recent time period possible. Okay, so you complete the worksheet by entering the necessary adjustments, computing the adjusted account balances, extending the adjusted balances into the appropriate financial statement columns, so just kind of pushing it over into the correct column, and entering the amount of net income for a period. The Magic capital account balance was $75,000 at December 31st, 20x1. Because the balance in the capital account remains at $75K at the end of 20x2, we know that there were no capital investments made during the year. The first step here is to record the adjustments. The company has earned $9,000 in fees that were not yet recorded at the end of the year. This is an accrued receivable. The adjustment is a debit to accounts receivable and a credit to fees earned. Next, we have $2,000 in salaries. This is B here. $2,000 in salaries expense not recorded at the end of the year. For simplicity's sake, assume it records any salaries not yet paid as part of accounts payable. This is an accrued payable. The adjustment, the journal entry, the adjustment for this is a debit to salaries expense and a credit to accounts payable for that amount. For C, the long-term note payable was issued on December 31st, so no interest is accrued on this loan. There is no required adjusting entry because no interest has accumulated. We do have a total of $11,000 of debits and $11,000 of credits recorded as adjustments. Next, we want to calculate the adjusted balances. The adjusted balance in the cash account is a debit balance of $13,000, accounts receivable $8,000 of debits plus $9,000 of debits in an adjusted debit balance of $17,000. The land balance was unadjusted, so that stays the same. Accounts payable, a credit of $10,000 and a credit of $2,000 for an ending balance of $12,000. Long-term notes payable, capital account, and withdrawal accounts were unchanged. Fees earned, a credit balance of $70,000 plus $9,000 results in $79,000 total. Salaries expense was $54,000 plus $2,000 for $56,000 total. Office supplies unadjusted. A total adjusted debit balances of $199,000 and the same for credit balances. Every account on the adjusted trial balance is an asset, a liability, or some component of equity, capital, withdrawals, revenues, or expenses. Assets are reported on the balance sheet. We transfer the adjusted asset balances to the balance sheet column. You just push it over there. Cash, accounts receivable, and land. Liabilities also appear on the balance sheet. So we transfer the adjusted balances in our liability accounts to the balance sheet columns. Magic's capital balance appears on the statement of owner's equity, as does the amount of Magic withdrawals. Fees earned should be a revenue account, so that goes on the income statement. Expenses as well goes on the income statement. And we transfer the amount, we would just transfer the amount to the income statement column. Total debits on the income statement, $64,000. Total credits on the income statement, which increase income, $79,000. Subtracting the difference, we get a positive balance of $15,000, or a net income of $15,000. Total, let's see here. Total debits in the balance sheet and owner's equity column total $135,000. Total credits $120,000. The $15,000 difference represents net income, which will be added to the statement of owner's equity. Total debits $135,000 equals total credits. I know a lot was going on there, but you can back up and look at each one of those individually. Take your time with it. Next, you want to use the information from the completed worksheet in the first part to prepare the adjusting entries. Adjustment A was a debit to accounts receivable and a credit to fees earned. Adjustment B, a debit to salaries expense and a credit to accounts payable. And then there was no required journal entry for Part C. Next, we want to prepare the income statement and the statement of owner's equity for the year ended December 31st, and then the unclassified balance sheet as of the date December 31st. The adjusted trial balance is presented in financial statement order, beginning with the assets. Assets appear on the balance sheet, so cash, accounts receivable, and land for a total of $115,000. The next are liability accounts. We've got accounts payable, long-term notes payable for total liabilities of $45,000. And then the remaining accounts are some component of equity. Magic's capital balance of $75,000 is the beginning capital balance on the statement of owner's equity. Magic withdrawals are then subtracted on the statement of owner's equity. Fees earned is a revenue account, which is included on the income statement as we already talked about. Then the final two accounts are expense accounts, and those again are subtracted on the income statement. Net income of $15,000 is transferred to the statement of owner's equity, and the ending capital balance is $70,000. Ending capital balance is then transferred to the balance sheet, so total liabilities of $45,000 plus ending capital of $70,000 equals the combined total of $115,000. So the closing process in and of itself is an important step at the end of the accounting period after the financial statements have been completed. It then kind of resets the accounts and gets everything ready for recording transactions and events for the next period. In the closing process, we first identify accounts for closing. Then step 2 is record and post the closing entries. And step 3 is prepare a post-closing trial balance. The purpose of the closing process has two parts, or two components. First, it resets revenue, expense, and withdrawals account balances to 0 at the end of each period. This also serves to update the owner's capital account for inclusion on the balance sheet. This is done so that these accounts can properly measure income and withdrawals for the next period. And then the second component is it helps in summarizing a period's revenues and expenses. Temporary or nominal accounts, as they're sometimes called, accumulate data related to one specific accounting period. In other words, they don't roll over to the next period. They include all income statement accounts, the withdrawals accounts from owner's equity, and the income summary account. They are temporary because the accounts are opened at the beginning of a period, used to record transactions and events for that period, and then closed at the end of the period. The closing process applies only to temporary accounts. Permanent, or sometimes called real accounts, report on activities related to one or more future accounting periods. that means that they carry their ending balances into the next period, and generally they consist of all the accounts that you might see on the balance sheet. These are 4 steps that we use every time we're going to go through this closing process. Step 1, close credit balances and revenue accounts to income summary. We'll go over all these as examples in our next class. So, knowing the steps at this point will be sufficient, and then we'll add some detail to that in next class. So the first closing entry transfers credit balances and revenue and gain accounts to the income summary account. We bring accounts with credit balances to 0 by debiting them, which is the opposite of the credit that's already in them. Step 2, close debit balances and expense accounts to income summary. The second closing entry transfers debit balances in expense and loss accounts to the income summary account. We bring expense accounts debit balances to 0 by crediting them. With a balance of 0, we're then ready for the next period in these accounts because each period in temporary accounts starts with a 0 balance. Step 3 is to close income summary to owner's capital. So after you've completed steps 1 and 2, the balance of the income summary account is the equivalent of net income for the period. So the third closing entry transfers that balance of income summary, or the effect of net income, to the capital account. This entry then closes the income summary account so that the income summary has a 0 balance after this entry is posted. And then it will continue and always have a 0 balance until you're ready to do the closing process for the next period. Step 4, close withdrawals account to owner's capital. So the fourth closing entry transfers any debit balance in the withdrawals account. These are owner withdrawals from the company's money. And it transfers those withdrawals to the owner's capital account. This entry gives the withdrawals account a 0 balance and basically resets it for the next period. So here's an example of that happening. Okay, we're going to use the adjusted trial balance of Magic Company to prepare the closing entries following the steps we saw in the previous slide. So as we talked about, permanent accounts are balance sheet accounts. The company has total assets of $115,000, total liabilities of $45,000, and the remaining accounts are equity accounts. We know that the total liabilities in equity must equal total assets of $115,000 based on the concept of a balance sheet and also the basic accounting equation. Total equity is $70,000, so you have the $115,000 minus $45,000 in total liabilities. So the end of the year balance in Magic Capital must equal $70,000. The income statement reports revenues of $79,000 minus expenses of $64,000 for net income of $15,000. Net income is transferred to the statement of owner's equity, where it's added to the beginning capital balance of $75,000. Withdrawals are subtracted on the statement of owner's equity. The ending capital balance is then $70,000. The closing process is the mechanical process of transferring the dollars from the temporary equity accounts to the permanent equity account, in this case for this company, Magic Capital. The closing process parallels the flow of dollars shown on the financial statement. So the first closing entry closes the revenue accounts to a new temporary equity account called income summary. Fees earned has a credit balance of $79,000, so to close that, we will debit the fees earned account for $79,000 and credit income summary. So that's the first journal entry that you see right there. The second closing entry closes the expense accounts, crediting salaries expense and office supplies expense, and debiting income summary for the total of $64,000, which you see right here. So these are what the closing entries for any type of revenue and any type of expense will always look like. Okay, they'll always have the income summary for expense accounts, and then the expense as the credit entry here. And then for the revenue side, you always have the income summary as the credit side, and the revenue earned as the debit side there. Okay, so the next step in the closing process is to close the income summary to Magic Capital account by debiting income summary and crediting Magic Capital. So that's what you see right here. In this case, the amount was $15,000. The final step in the closing process is to close the withdrawals account by crediting the withdrawals account for $20,000 and debiting that same amount from Magic Capital. Notice that the withdrawals account is not closed to income summary because withdrawals is not part of the calculation of net income. The balance in Magic Capital at the end of the period is now $70,000. Once all of the revenue, expense, and withdrawal accounts have been closed, the remaining balances appear on a post-closing trial balance. The ending balance in Magic Capital now agrees with the amount reported on the balance sheet. After all 4 of our closing entries have been made, we prepare a post-closing trial balance. This is just a list of permanent accounts and their balances from the ledger after all closing entries have been journalized and posted. It lists the balances for all accounts that have not yet been closed because they're permanent accounts. These will consist of assets, liabilities, and equity, which are obviously identical to those accounts you would see on the balance sheet. So here's an example of a post-closing trial balance. Next, we're going to talk a little bit about the overall accounting cycle. This is just all of the steps that make up a typical accounting process. Okay, you'll see here in step 10 that this is optional. It complicates things a little. It's in the appendix in your chapter. And for the purposes of principles of accounting, I generally would just skip the appendices. And then you will see if you get further into accounting and intermediate accounting, we'll go over those things in more depth. Okay, so these are all the steps in the accounting cycle. A classified balance sheet organizes assets and liabilities into important subgroups that provide some more information to decision makers. A classified balance sheet is the most popular format used by business. On the asset side of the balance sheet, we group assets as either current or non-current. A current asset is one that is expected to be converted into cash within the next year or within a company's normal operating cycle, whichever is longer. So some companies, in an operating cycle is just the time it takes to acquire inventory, sell the inventory, and collect cash. So for most companies, this cycle happens many times during a year. But there are some companies that produce assets that are maybe really expensive, like, for instance, like big passenger airplanes. The process of acquiring inventory, selling inventory, collecting cash may take longer than a year for a big dollar item like that. So in those cases, the balance sheet current asset section would include items that could be turned into cash within that operating cycle. On the liabilities plus equity side of the balance sheet, we divide liabilities between current and non-current, with the current liabilities being liabilities that we would expect to have to pay out of companies' current assets, again within either the next year or the normal operating cycle. So we talked about that already. So it holds that long-term investments are expected to be held for more than 1 year or an operating cycle. So whenever you see current, generally that means within 1 year. Long-term, generally that means longer than 1 year. Plant assets are tangible assets that are both long-lived and also used to produce or sell products and services. Some examples of these are equipment, machinery, buildings, and land that are used to produce or sell products and services. Intangible assets are long-term resources that benefit business operations. Intangible means lacking a physical form, and these may also have uncertain benefits. Some examples of these are patents, trademarks, copyrights, franchise rights, and goodwill, which is just kind of the name value or the name recognition value of a company. We talked about what current liabilities are already. So long-term liabilities are anything longer than the current liabilities. Equity, again, we've talked about this. This is just the owner's claim on assets. So here we're going to use the adjusted trial balance to prepare a classified balance sheet as of December 31st. So a classified balance sheet includes subtotals for current assets versus plant assets and current liabilities versus long-term liabilities. Current assets, we talked about what the definition for that is. We talked about the definition for all of these. The $75,000 balance in Magic's capital account is beginning capital, but it's not hard to calculate the ending capital in this case. Ending capital includes all of the income statement and statement of owner's equity activity. Magic capital at the end of the period equals the beginning capital balance, $75,000, plus the revenues, $79,000, so 75 plus 79, minus expenses of $64,000, and withdrawals of $20,000, so minus a total of $84,000. That makes the ending balance in Magic's capital account $70,000. We calculate the subtotals for each of our categories: total current assets having $30,000, plant assets $85,000, total assets $115,000, total current liabilities $12,000, total liabilities $45,000, and then total equity $70,000 for a total liabilities plus equity of $115,000. Finally, we are going to talk a little bit about the current ratio. So a current ratio will help outside investors or potential creditors to assess a company's ability to pay its debts in the near future. To calculate it, all we do is add up from the previous slide. Let's go back to that real quick. Anything that's under the current assets section divided by, as you see right here, anything that's under the current liabilities section. Okay, so current assets here divided by current liabilities here, and that would give us our current ratio.